Canada has passed 7 major laws reshaping trade, tourism, energy, and agriculture ties with the U.S. If the wave of Canadian retaliation keeps spreading, could the current federal economic structure withstand a deepening rift between the hardest-hit states? Canada enacted 7 laws over 6 weeks, directly affecting U.S. commerce and travel: a digital tax on Google and Meta, a Travel Safety Act warning citizens against visiting certain U.S. states, a ban on non-sanitary food imports, an energy export licensing law limiting electricity exports to the U.S., a 72-hour auto retaliation tariff rule following U.S. actions, cuts in funding for U.S. tourism promotion, shifting focus to Canadian and European travel. The new Canadian laws are set to drive up living costs for Americans in border states, where as much as 30% of local energy and food supplies depend on Canadian imports. Job losses in tourism and agriculture could exceed 100,000 positions. If cross-border travel and trade slow sharply, local communities may face revenue drops of up to $2 billion within the first year. Florida lost over 76% of Canadian visitors, devastating the tourism sector and snowbird communities, while orange exports were rejected over pesticide concerns. Michigan saw automakers hit by retaliatory tariffs, tourism drop by more than 11%, and apple and dairy exports blocked. Texas lost energy deals, had cattle and cotton shipments returned, and experienced a sharp decline in visitor numbers affecting cities like Houston and Dallas. Iowa faced refusals on pork and soy, fertilizer prices surged, and ethanol plants shut down. New York lost 3.5 million Canadian tourists, saw tourism revenue decline, and Wall Street lost data ad contracts. Minnesota endured 15 to 20% electricity price hikes after Canada choked energy exports from Manitoba. Border tourism fell 31%, and farm and digital AD sectors were boycotted. States relying on Canadian trade, tourism, or electricity will face higher costs, rising unemployment, and slumping local revenues. Travel infrastructure and agriculture sectors could suffer major disruption. Additional context: analysts estimate these laws could disrupt supply chains, leading to shortages and delays for American consumers and businesses. Higher compliance costs may even drive price increases for everyday goods like produce and household energy. Tourism: cross-border visits fell by over 35%, especially in Florida, Michigan, and New York. Energy: power shipments to Minnesota and Michigan blocked by new licensing mandates. Agriculture: Florida oranges, Iowa pork, Michigan apples, and Texas cotton rejected over quality disputes. Major U.S. businesses in ethanol, food processing, and domestic tourism face losses totaling billions. Family run-ins, local shops, and farms, for which Canadian visitors comprised a vital customer base, are now closing, cutting wages, and losing contracts. Rural communities find supply chains strangled, with no immediate relief in sight. Added detail: forecasters warn that continued disruption could depress rural economies for months, if not years. Homegrown farmers may need to seek new markets, while small businesses might be forced to downsize or shutter, pushing more Americans into economic uncertainty.
America's auto industry is facing an unprecedented challenge as new car inventories hit record highs and consumers walk away from new vehicles. With dealerships struggling and car prices soaring, could this crisis permanently change how Americans think about car ownership? As of May 2025, U.S. new vehicle inventory has surged to over 2.84 million units, with an average 80-day supply for EVs, SUVs, and luxury models. It exceeds 100 days. Dealerships in Texas, Arizona, and Michigan are cutting staff, downsizing, or seeking foreign buyers, signaling a major industry shift. The sudden glut of unsold cars has left hundreds of thousands of dealership employees at risk of losing their jobs. Local communities are seeing a sharp drop in tax revenue and economic activity, putting public services and small businesses in jeopardy. For many towns that rely on auto sales as their economic lifeblood, this downturn means real hardship for families, workers, and local governments who are struggling to adapt to the new reality. In 2025, the average new pickup costs $54,000, up from $38,000 just 6 years ago. Auto loan rates now average nearly 10%, with some buyers paying 15 to 22% due to imperfect credit. A $24,000 loan on a $32,000 car can mean $650 monthly payments, more than many mortgages. As a result, Americans are keeping older vehicles, often with over 200,000 miles, to avoid unsustainable debt. With soaring prices and sky-high loan rates, millions of Americans are forced to drive aging, high-mileage cars. This trend brings more breakdowns, higher repair bills, and growing safety concerns. The stress of mounting financial pressure is eroding consumer confidence, especially among the middle class, who now feel shut out of the dream of new car ownership. Electric vehicles and luxury SUVs now comprise a growing share of the over 750,000 vehicles unsold for more than 100 days. Despite EV price cuts of up to 50%, buyers remain scarce as they sit unused. Batteries degrade, tires crack, and paint fades, turning them into liabilities for dealers and automakers. Major automakers like Ford, GM, and Stellantis have cut production by 35 to 40%, causing tens of thousands of layoffs. The rapid depreciation of new technology has shaken public trust in electric vehicles. Many Americans are now hesitant to embrace modern cars, fearing their investment will quickly lose value. The dream of a green automotive future feels more distant, while the risk of job loss in manufacturing communities has grown. As car makers cut orders, parts factories in Ohio, Michigan, and Tennessee are shutting down. Over 50,000 auto jobs have been lost in just 6 months, per Bloomberg and the Wall Street Journal. The ripple effects reach banks, pension funds, credit unions, and school budgets. Entire communities, from teachers to grocery store owners, are being swept up in the crisis. As the auto industry's decline ripples through the local economy, small towns are losing their industrial identity and facing the prospect of long-term poverty. Job losses are undermining the stability of families and neighborhoods. U.S. tariffs on Chinese imports and rising trade tensions are disrupting domestic industries and fraying supply chains. Why are U.S. imports plunging despite high tariffs? And why aren't tariffs saving industries while prices keep rising? U.S. slapped a sweeping 145% tariff on Chinese steel, aluminum, and components. Yet, imports still plunged 28.5% in May, year on year, to 2.18 million TEUs, the steepest drop since the pandemic. Nearly every West Coast port saw declines, Long Beach down 31.6%, and Los Angeles down 29.9%. Shipping lines have cut at least 6 Asia to U.S. routes, as warehouses brace for emptier containers. Shelf shortages in electronics and home goods could hit within 5 to 7 weeks, as inventory dries up. Import costs have surged. U.S. steel and aluminum duties add over $100 billion annually, inflating household expenses. A Reuters Ipsos poll finds 73% of Americans expect higher prices in the next 6 months. Economic strains are already pushing consumer sentiment to near 3-year lows. From January to April 2025, the Bloomberg Dollar Index tumbled from 105 to under 95, losing roughly 10%. Yet analysts warn, this hasn't lifted U.S. manufacturing. A Morgan Stanley Moody's alert points to stagflation risks if industry remains fragile. With inflation sticky, essentials cost more. U.S. CPI hit the 2.3 to 2.5% range, and lenders are hiking rates. Weak dollar didn't stimulate exports meaningfully, while households face higher mortgage costs and rent. A Fed Beige Book notes uneven growth and pressure on input prices across regions. Consumer confidence remains shaky, especially among ages 30 to 44, with 60 to 70% planning to cut spending or stockpile. Ford halted production at its Chicago plant in May due to lack of Chinese rare earth magnets. GM, Stellantis, and Toyota are urging federal action to avoid deep supply chain collapse. Fewer new vehicles hit showrooms, pushing used car prices up 4.9% in April, per Manheim Index at 208.2. Listings show median used sedan prices rose by $2,500 year over year. Maintenance costs jump as parts become scarce, with dealers alerting roughly 30% increase in magnet-dependent repairs. Communities near auto plants worry about layoffs as output holds steady or declines. Meanwhile, Beijing has cut interest rates and supported its currency, while keeping exports stable. In contrast, U.S. tariffs have stoked supply interruptions. Without shifting global trade balance, the U.S. sees its dollar debilitate and industrial employment unravel. Auto sector job losses may rise. As factories scale back, the CBO estimated 500,000 U.S. jobs lost, and households pay an extra $4,000 annually due to tariffs. Import taxes are embedded in everyday goods. Retail giants like Walmart report 8% price hikes on pet food and essentials. Roughly $3,800 per household is expected to be absorbed this year. The Trump administration is ramping up pressure on Japan, demanding interest rate hikes, imposing heavy tariffs on automobiles, and triggering consequences as Japanese investors retreat from U.S. Treasury markets. Could this mounting tension spark a new wave of financial instability for both economies? On June 25, 2025, minutes from a Bank of Japan policy meeting, obtained by Reuters, exposed internal disagreement over the path forward. One group warned that tightening interest rates would threaten Japan's already fragile post-pandemic recovery. They cited stagnant domestic demand, shrinking corporate profits, and the 0.2% GDP contraction in the first quarter of 2025 as signs that any further monetary restraint could tip the economy into recession. Conversely, a more hawkish faction within the BOJ pointed to persistently elevated core inflation, now running at 3.1%, well above the bank's 2% target. They argued that inflationary pressures, if allowed to build, would erode real incomes, especially for households on fixed or low wages. Overlaying this internal tug-of-war is external pressure from Washington. The U.S. Treasury has reportedly urged Japan to raise rates to boost the yen and help narrow the U.S. trade deficit. A stronger yen would also support U.S. bond markets by making dollar-denominated assets more attractive to Japanese investors, at a time when U.S. Treasury auctions are showing worrying signs of investor fatigue. For Japan, this represents a classic monetary policy dilemma. Raising interest rates to satisfy international expectations could risk tipping the domestic economy into deflation, while holding rates too low risks further weakening the yen and stoking inflation. Adding to the complexity, Japan is also navigating structural issues like population aging and sluggish productivity growth, which make bold monetary moves even riskier. In short, Japan is being asked to balance competing interests, domestic stability versus global responsibility. That balancing act is growing more precarious by the day. Among the clearest victims of the current economic standoff is Japan's automotive sector, especially Toyota, a global bellwether and symbol of Japan's manufacturing strength. Since April 2025, U.S. tariffs of 24% on Japanese vehicle imports have inflicted direct financial damage. Toyota has already reported $1.3 billion in losses over just 2 months, prompting the company to slash its full-year profit forecast by 20% to 3.88 trillion JPY, $26 billion. But these figures only scratch the surface. The tariffs have triggered a broad reevaluation of Toyota's North American strategy. The company's sprawling global supply chain, spanning Asia, Europe, and the US, is now more expensive to operate due to tax burdens and increased logistics costs. Key components face delays or require resourcing, adding volatility to production timelines. According to JETRO, nearly 20% of Japan's total exports come from vehicle sales to the US, which underscores how vulnerable the Japanese economy is to such targeted tariffs. Japanese suppliers and subcontractors, many of which operate on thin profit margins, are also under strain, with some reporting a 20 to 25% drop in orders. If the situation persists, this could trigger layoffs, factory closures, and a cascading impact on regional economies in both countries. Meanwhile, U.S. consumers are not insulated from these effects. As manufacturers pass along the cost of tariffs, prices of new vehicles are rising, particularly for sedans and hybrid models, which are popular among middle-income families. This could create a ripple effect in the broader economy, as higher monthly auto payments reduce disposable income and weigh on retail sales. Furthermore, the retaliatory tariffs risk undermining U.S. automakers who rely on Japanese parts. The industry as a whole is caught in a policy-induced squeeze, one that reduces global competitiveness without offering a clear path toward local job creation or price stability. A less visible but equally consequential front in this economic standoff is unfolding in the U.S. bond market. In the most recent $22 billion auction of 30-year treasuries, domestic investor participation slipped to just 14%, down from the 6-month average of 17%. To attract buyers, yields spiked to 5.12%, a level not seen since 2011, raising alarms about the government's rising cost of debt service. Japan, traditionally one of the largest holders of U.S. treasuries, has begun paring its exposure. Analysts point to 2 main reasons: increasing volatility in the U.S. dollar and more attractive opportunities in euro-denominated infrastructure bonds, which carry lower geopolitical risk. This reallocation away from treasuries means the U.S. must rely more heavily on domestic investors or short-term instruments, potentially destabilizing long-term funding plans. The implications are sweeping. Higher yields raise the cost of borrowing across the economy, affecting home mortgages, car loans, and business credit. For federal and state governments, it means rising interest obligations that could crowd out spending on infrastructure, healthcare, or defense. In short, a decline in foreign confidence in U.S. debt poses a systemic risk to financial stability. Compounding the concern is the potential feedback loop between rising borrowing costs and investor sentiment. As yields climb, fears of unsustainable debt servicing may prompt even more sell-offs, creating volatility in financial markets and uncertainty in capital investment decisions. If the retreat continues, the Federal Reserve may be forced to intervene, either by increasing bond purchases, re-expanding its balance sheet, or by adjusting interest rates, which could further complicate its inflation-fighting mandate. What we are witnessing is not merely a dispute over trade or a routine interest rate debate. This is a multi-layered confrontation involving currency policy, industrial strategy, sovereign debt, and global financial trust. As Japan walks a fine line, and the U.S. juggles fiscal strain with geopolitical assertiveness, both countries risk unintended consequences. The coming months will be critical. Without a coordinated path forward, or at least a diplomatic thaw, these economic stress points may intensify, with ripple effects that stretch far beyond Tokyo and Washington. What began as tariff skirmishes now risks morphing into a broader conflict of confidence, one that could test the resilience of both economies and the stability of the global financial system. In a strategic turn, Canada has withdrawn its proposed digital services tax just hours before implementation and launched its first ever LNG export shipment to Asia. These coordinated steps reflect a dual strategy aimed at preserving trade relations with the United States while asserting Canada's emerging position as a global energy power. On June 30th, 2025, just hours before its planned implementation, the Canadian government officially suspended its 3% digital services tax, DST. The tax was set to apply retroactively from 2022. It was intended to target large US-based technology companies, including Amazon, Google, Meta, and Apple, and could have generated an estimated $2 billion USD in federal revenue. However, the tax had also become a flashpoint in US-Canada relations, risking a potential trade dispute during a particularly sensitive period in bilateral negotiations. According to reports from Reuters, Ottawa's decision to halt the DST was made to preserve the stability of ongoing trade negotiations with the United States, especially amid mounting pressure from the Trump administration, which had threatened retaliatory tariffs on Canadian exports. Though the tax mirrored policies already adopted in France, Italy, and Spain, the United States viewed it as a discriminatory move targeting its technology sector. By suspending the tax, Canada signals a preference for dialogue over confrontation. The Canadian government emphasized that the pause was designed to create room for bilateral trade solutions, rather than escalate tensions with its largest trading partner. This retreat, while temporary, was viewed by economists as a pragmatic move that protects broader economic interests. At a time when cross-border investment and supply chain security remain fragile, financial markets reacted swiftly. Canada's S&P TSX Composite Index reached a record high following the announcement, reflecting investor optimism about renewed stability in US-Canada economic relations. On a societal level, the suspension avoided potential cost increases in digital services, such as advertising, e-commerce, and streaming platforms, offering immediate relief to consumers and small businesses alike. Exporters, especially those in manufacturing and energy, also gained short-term security from potential trade disruptions. In a milestone event on the same day, the LNG carrier Gazlog Glasgow departed from the port of Kitimat, British Columbia, carrying Canada's first shipment of liquefied natural gas bound for Asia. The cargo marked the official launch of LNG Canada, the largest natural gas infrastructure project in Canadian history, with a design capacity of 14 million tons of LNG per year, equivalent to 1.9 billion cubic feet of gas per day. The facility is projected to generate up to $8 billion USD annually at full operation and create thousands of jobs in British Columbia and beyond. The shipment is en route to key energy markets in Japan, South Korea, and China, three economies actively seeking to reduce their reliance on coal and diversify energy supply chains for long-term security. The expansion into Asia provides Canada with a crucial opportunity to lessen its dependence on the U.S. market, which in 2024 accounted for an average of 8.8 billion cubic feet of Canadian natural gas exports per day via pipeline. The launch is more than a commercial achievement. It marks Canada's entry into the ranks of global LNG exporters. It also reflects shifting post-pandemic and post-Ukraine conflict supply strategies, where Asian nations seek stable, low-emission alternatives to fossil fuels sourced from politically volatile regions. With its geographic advantage and abundant natural gas reserves, Canada presents an increasingly attractive energy partner. Strategically, LNG Canada is the result of nearly a decade of coordinated infrastructure planning, environmental permitting, and foreign investment, primarily led by Shell, alongside Petronas, Malaysia, Mitsubishi, Japan, PetroChina, and KOGAS, South Korea. This diverse partnership reinforces the project's long-term resilience and alignment with Asian importers' growing appetite for secure, low-carbon energy sources. Following its first LNG shipment, Canada is advancing plans to scale its role in the global clean energy market. Shell, the lead developer, has announced a second phase of the LNG Canada project, which includes 2 additional liquefaction units. This would increase total output to 26 million tons annually before 2030. Shell forecasts global LNG demand to rise by 60% by 2040, with Asia driving most of that growth as countries shift from coal to gas. Nations like Japan, South Korea, China, and India are actively seeking long-term LNG contracts with low emissions profiles, an area where Canada offers a competitive advantage due to its naturally sweet gas, high environmental standards, and Pacific coast proximity. Canada's LNG supply chain is further strengthened by a broad investment network involving Shell, Petronas from Malaysia, Mitsubishi from Japan, PetroChina, and KOGAS from South Korea. This multilateral ecosystem reduces financial risk and increases long-term contract viability. An appealing proposition in a post-Russia, post-Middle East supply realignment. Strategically, Canada's LNG expansion reshapes its role in the global natural gas trade. Once dependent on U.S. pipelines, it is now positioning itself as a flexible, lower-emission LNG exporter. This move supports national economic diversification while enhancing GEO political influence in energy alliances of the 21st century. Ottawa appears to be capitalizing on this historic opportunity with deliberate precision. By withdrawing the digital tax, launching LNG exports to Asia, and unveiling expansion plans, Canada is executing a calculated strategy to reshape both its bilateral trade profile and global energy position. The decision to pause the DST preserves stable relations with the United States, avoiding retaliatory tariffs and potential damage to critical exports. At the same time, the breakthrough in LNG exports opens a new chapter in energy diversification, reducing dependence on the U.S. market. With rising liquefaction capacity, multilateral investment, and competitive access to Asia, Canada is emerging as a key LNG hub. These moves reflect not only short-term adaptability, but also a long-term vision for transforming the national economy amid global uncertainty. Canada is stepping forward as a central player in the energy transition, and doing so on its own terms. 70%. That's the maximum tariff President Donald Trump has threatened to impose on imports from 14 countries starting August 1st. Is this the foundation of a new economic fortress, or the first crack at America's place in global trade? President Trump has issued what many are calling a global trade ultimatum. 14 countries have been warned. Sign bilateral trade agreements with the U.S. by August 1st, or face import tariffs ranging from 25% to 70%. So-called tariff letters were sent out in early July, stating bluntly, "Agree to our terms," or face severe tariffs. This move, part of Trump's America First economic doctrine, could lead to immediate consequences for American consumers. Without new agreements, prices for everyday goods, from electronics to food, medicine, and spare parts, may rise sharply in August. Retirees and middle-income workers, who rely heavily on these essentials, are likely to be hit the hardest. Among the targeted countries, Japan and South Korea stand out. President Trump has confirmed a blanket 25% tariff on all imports from both nations, effective August 1st. That includes vehicles, auto parts, electronics, and high-end consumer goods. Both Tokyo and Seoul are scrambling to negotiate exemptions, but so far, no agreement. For American households, the impact could be felt in rising costs. Car repairs, electronics, and household appliances. Older citizens relying on medical devices or home technology, they'll likely see their monthly expenses climb. Markets responded swiftly on and negatively to the tariff announcement. The Dow Jones dropped 0.94%. The S&P 500 fell 0.79%, and the Nasdaq lost 0.91%. Shares in the automotive, retail, and tech sectors led the decline. Tesla, for instance, plunged 6.8%, driven by rising production costs and export risks. For Americans with retirement funds, stock portfolios, or savings tied to these sectors, this means immediate losses. And if major companies start pulling back on investment, job cuts could follow in the coming months. As of July 7th, only 3 nations, the United Kingdom, Vietnam, and the United Arab Emirates, have reached trade agreements with the U.S. key partners like the EU, Japan, South Korea, and Canada, still unsigned. In response, Canada is now pursuing independent trade deals with Europe and Asia. Meanwhile, ASEAN, the EU, and BRICS are reportedly exploring new trade blocs, independent of U.S. influence. If this trend continues, the U.S. could lose significant export market share. That would put millions of jobs at risk in manufacturing, agriculture, and logistics, especially across key industrial states. American consumers, too, may find fewer choices on store shelves and face consistently higher prices.